CA Prasad Kumar, renowned speaker of today's virtual seminar, CA S.Dayanidhi garu, respected past chairman, senior members of the profession, my dear professional colleagues, my colleagues in the management committee, a very good evening to all of you and welcome to you all to this virtual seminar on this topic of stock and receivable audit, which is very, very crucial to all of us. We express our heartfelt thanks to our CA S.Dayanidhi garu for accepting our request and to give the deliberations on the stock and receivable audit. So, because you all know this stock and receivable audit means basically this is based on the working capital finance. Working capital funds finance, both fund-based and non-fund-based against the primary security of hypothecation of stock and book debts is one of the most common modes of the finance frequently adopted by the banks. The borrower in such cases are expected to submit the stock statements and debtors every month, on the basis of which drawing power after reducing the prescribed margin is calculated. The main objective of the stock audit is to ascertain whether the security of the borrower's stock and debtors against which working capital finance has been given is safe and is valued correctly. It is the duty of our stock auditor to verify the physical existence and absolute ownership of inventory and movable property charged to the bank, to examine the genuineness of the sundry debtors list submitted by the borrower. The various objectives expected to be achieved through the stock audit may be summarized as follows. The physical verification of the value of the paid stocks by excluding the total value of unpaid stocks with reference to the level of trade creditors and the value of stocks procured under the non-fund based limits, that is letter of credits and bank guarantees from the total stocks available to the borrower's location and godowns, stock yard, as the case may be, and confirm that the same together with the eligible stock book debts are sufficient to cover the total amount of outstanding to the working capital limits along with the required level of margin. To verify whether the value of the stocks procured available on the date of physical verification along with the eligible book debts emanated from the sale of such goods is sufficient to cover the outstandings in the fund-based limits, including the bank guarantee limits for supply of goods. To verify related records and registers, books of account such as stock registers, register of sales, GST returns, purchase invoices, sale invoices, credit notes, debit notes, etc., including data in digital form maintained in Tally, SAP or ERP, etc. by the borrower. To carry out physical exam to the stock to ascertain the quality, slow-moving goods, non-moving goods, value of the age of the inventory levels, and identifying whether they are existing and obsolete stock, and if yes, whether it has been segregated and written up and accelerated while arriving at the drawing power, to ensure proper preservation and storage and handling of the stocks. In cases applicable to CERSA registrations, any other charge and payments of any bank guarantee fees, etc., is also to be verified. To ensure eligible stocks are under our bank hypothecations have not been hypothecated to any other banks. In case of consortium and multiple banks arrangements, the stock is to be verified in such a fashion that the entire stock related to be verified and this value of the security should be sufficient to the entire consortium at once. So to comment on the turnover of the account of the confirming it is commensurate with the sales in case of sole or consortium and multiple banking arrangements, auditor should also reconcile the realized GST sales with the turnover of the account. To examine the end of the funds and verify whether any diversion of funds, interlocking of funds among associate concerned, sister concerned, etc. So in addition to that, the physical very existence of this, because we are the chartered accountants, the status and book debts, as per the level of book debts maintained at the working capital while arriving that to be mainly maintaining or not, that is important. general overview of the borrower's unit, whether security coverage is adequate, correctness of data and stock statement, check quality of the goods, verification of the books of accounts are updated, check systems and issue reconciliation of physical quality, pricing materials including work in progress and finished goods, confirmation of the balance of the book debts by the respective parties to verify the creditor figures to ascertain the unpaid stocks. In addition to that, this audit and reviews of historical financial information regard the standards and auditing 100 to 999, standards and review of the engagement 2000 to 2699, and standards and assurance standards 303699, standards related to services 4699, and especially this SRS 444400 is to be verified, and whether all these material information to discuss, deliberate, and to give us a valuable solutions and advices by the valuable our speaker, Sri S.Dayanidhi Garu. Today's speaker will deliver all such issues, and to enlighten about various other aspects of the stock and receivable audit and audit quality, we have eminent speaker with us today, CA Dayanidhi Garu. And with this, once again welcome you all for this program. Now I request CA Sridhar Garu to introduce today's speaker for this session. Thank you, sir. I welcome once again to Speaker Garu for this session. Thank you.
Good evening, everyone. S.Dayanidhi Garu is born and brought up in Chennai. He has completed his graduation and chartered accountancy from Chennai. He is a managing partner of Mrs. Dayanidhi and Co. He is a faculty of certificate course on concrete type of bags, ESA, GST, and forensic audits and fraud detection audits. He is a visiting faculty of various other premier institutes across India. He is a visiting faculty of bank staff training colleges. He has written many articles on prudential norms, frauds in bank sector, and which were published in newspapers and our institute journals. He has presented various papers in all regional headquarters of the ICAI. He has visited more than 100 ICAI branches across India and presented various papers on several topics. For more than 25 years, he involved in various types of bank audits such as separate statutory audit, branch statutory audits, stock audits, pre and post migration audits, risk-based audits for banks and financial institutions, ALM audit for few banks. He has undertaken special audit assignments such as fraud detection and investigation in various banks. He has also created a group in the name of Nest of Auditors for the benefit of practicing chartered accountants and sharing information on research, circulars, and notifications, professional opportunities in banking, and clarifying doubts raised by the auditors. With these few words, I introduce Sri S.Dayanidhi Garu to the August Gallery. Thank you, sir.
Sir, Dayanidhi Garu, now you can start, sir.
Yeah. Thank you, sir. Thank you very much. I thank this Vaisak branch having invited me for this wonderful session on the stock and receivable audits. I thank the chairman, vice chairman, and the secretary, and Mr. Sridhar Sarji, who has presented about my my credentials in a elucid manner. It's an opportunity for me to interact with you people. In fact, I visited about 1 year before in your branch in connection with the certificate course on concurrent audit. It was a wonderful occasion for me to interact with the August audience. So it was very, each and everybody who was participated in a live environment. So I was waiting for the opportunity to meet you once again.
Definitely,
so I think this opportunity somehow it has realized, come to a realistic because of none other than Mr. Chandrasekhar, who is close friend of me. He has introduced me to your present chairman. Then the present chairman requested me to take up some topic on this stock and receivable audits. I always think Vizag is a wonderful place in two reasons. Always it is lingering in my mind. One is because of this, the climatic and the geographical setup where it is surrounded by the mountains, very good scenery, particularly when we see from the flight. Then second reason, always it becomes the shock absorber of the Chennai people. So whenever the monsoon, whenever there is a cyclone symptoms, when it starts attacking the Chennai, so when slowly it will go and land up in the Vizag. So that way, many circumstances, you people are always protecting us. You are shouldering all the pain and of the cyclone impact. So that way, always I used to be thankful to, on behalf of the Chennai, I always thankful to this each and every resident in Vizag. So this, I think this is the right time you people chosen the topic on the stock and receivables. The reason is that this is the time for, if you take this bank audits, where they have allotted the specific time for this specific type of assignments. Many assignments are given to the chartered accountants, various types of assignments in the bank audit, of which this is a period somewhere in August. The appointment of the stock audits always it starts. So this is the right time for you to have this kind of interactions with reference to the stock and receivable audit. 1 minute, I'll share my presentation. I think now my PPT is visible to you or no?
Yes, sir.
PPT, yeah. So this is the right time for you who have chosen the topic. I think there are many branches. They used to call me to give some tips on this stock audit. So that's this time you are the first branch to approach me, and you are it shows you are the manner in the understand the requirement of your members and catering their needs. So there are many audits are there in the banking industry. Like if you take the statutory audit, it is quite remunerative, but other audits are not that much remunerative. Even it will not cover even the cost. If you take the concurrent audit, no doubt about what is the cost. We know very well. Then stock audit, then the revenue audit. Like that, there are various audits are there. Then forensic audit is a specialist audit. But among the various audits, the stock and receivable audits is a very, very major role for the chartered accountant, because it determines the value of an asset. So that is being offered to the bank for the on the daily funding. See, this stock audit is something is different from this even the valuation of the property, which is being happening once in 3 years as per the RBI guidelines. Whenever some properties are offered to the bank as a main security or a collateral security. But this, when you say it's security to the bank, there are two types of securities. One is the primary security, another one is the collateral security. So the primary security is nothing but a security which is coming to existence out of a bank finance. So stock and receivables, there is a direct relationship between the assets which are in existence vis-a-vis the exposures which are happening, bank exposure. So the direct relationship always there in respect of the stock and receivables. That is the reason it is main importance in the banking scenario to ascertain whether the adequacy of the stock is available, whether the creditors are properly disclosed in their stock statement. Further, the receivables which they are declaring month-on-month basis, whether it is commensurate with their activities. So these are all the major, because unlike these other type of valuations, the valuations takes place once in the 3 years. Whereas the stock valuations and the reporting of the stock and inventories are happening on month-on-month basis. At the later, not more than once in 3 months. RBI permits to submit the stock statement once in 3 months, maximum period up to 3 months. If any stock statement not submitted more than 3 months, then that account unit is going to be treated as an NPA. So that is the situation. So much of importance is given as far as the stock and receivables are concerned. The main responsibility of the stock audit is not only to focus on the value of the stock, so which is going to be taken place at the time of inspection. More than that, the role of the stock auditor is to find out whatever is happening over a period of 1 year. That is also is the part of the scope. So that is the reason the responsibility of the stock auditor is a much larger than the other type of bank audit assignments. See, many of them think that the forensic audit, it is one of the foremost important audit assignments to professionals. I would say the stock audit, even it is much more responsible oriented exercise than the forensic audit. The reason is that the stock audit, when the stock audit will be appointed, stock audit will be appointed only when the account is in standard advances. Whereas in the case of the forensic audit, when it will be appointed, when the account is slipped to an NPA, when the bank management finds there is an irregularity, mismanagement, diversion of funds, only at that stage, the emphasis for the forensic audit. So here are the two scenarios. The first scenario, the situation where the management is not yet ascertained or rather not yet declared the party is a critical or it is a willful defaulter. So under the scenario, so we are venturing into this assignment. So here, you know very well the type of support and which is normally which is being extended to an auditor whenever we take up an assignment. So that too, it is a stock audit, the audit which is not only to be conducted in the branch. If it is conducted in the branch, somehow we'll try to get things done. But unfortunately, we'll have to move out of the branch and go to the borrower's place and get the information. These are the real challenges to each and every auditor to how to handle these things. I come across many circumstances. I would say so far, out of my 3 decades of experience as a auditor, and not even I would have conducted more than 100 stock audits. Out of these 100 stock audits so far, I am not even satisfied with one stock audit where I got this all the information, relevant information, whatever information I call for. Ultimately, I end up in a report with a disclaimer of certain circumstances. So under these circumstances only we are carrying out this stock audit assignments. So this is one of the highest challenge each and every stock auditor will have to face it when we take up a assignment. Whereas in the case of if you take this forensic audit where the management is already declared, so they are also to some extent they know very well. So they are adding to their conclusion, they are engaging the forensic audit. Whereas in the case of stock audit, it is not that. There are many instances the management know pretty well the irregularities and non-cooperation of the borrowers as a matter of compliance, as a matter of many circumstances, as a matter of compliance, procedural requirement envisaged by the Reserve Bank of India by way of the circular, they appoint the stock auditors. So in that circumstances, there will be a non-cooperation by the borrowers. In such a situation, how to handle such stock audit, how to come out of the report. I come across many instances where the stock audit is being conducted and a lot of information and negative remarks about the borrowers we have observed. But when we place the report before the bank management, so how they are reacting, whether they are accepting our comments and the observation in a positive approach. Many of them are not accepting it. They want this reports to be done according to their expectations. If such serious lapses, irregularities are there, they want to save their skin. For that, they are pressurizing each and every concurrent auditor to submit the report in such a way to protect the bankers. But in that scenario, what is our role? What is our responsibility? What extent will have to be straightforward in submitting the reports, whatever observation? These are the real challenges we come across whenever we take up an audit. So with this small brief about this stock audit assignments, let us go into this each and every areas for discussion. First, the scope of stock audit, which comprises of number one, as per RBI guidelines, all the advances above 1 crore are subject to yearly audit by an outside chartered accountant or cost accountant. Now, the CA firm should be in the bank panel for this specific assignment. See, when I'm saying this bank empanelment for the stock and receivable audits, see, you don't believe, friends, nowadays the main bankers are treating the chartered accountant firms like a very worst scenario. They ask so many informations for the stock and you might have seen that recently there is an empanelment applications request from the Union Bank of India. This Union Bank of India for empanelment of stock and receivable audits, how many information they have asked? They are asking so many informations, which is not at all required. But we are, as a matter of the procedure to empanel, we are under compulsion to submit all the informations. So you will have to get ready whenever there is an, whenever you prefer to engage, you apply for an empanelment. So whatever requirements issued by the bank, so all the informations, all the data, all the certificates, all these things, we'll have to keep it ready and we will have to upload all the informations. So then only our name is getting empaneled. So I would say this in the recently, what happens, the importance of stock and receivables audit given much more attention rather than the concurrent audit. I would say the same, the Union Bank of India approach for the empanelment of concurrent audit is different from the empanelment of stock and it is not only this Union Bank of India which has come recently. That's why I said, even if you take the Indian Bank, which is recently, they have asked empanelment for the concurrent audit and stock and receivable audit. So nowadays the bankers, their approach towards the empanelment of a chartered accountant firm or the cost accountant firm has undergone tremendous changes. They don't believe the whatever documents which we are submitting online. They want the authenticity of each and every documents which are submitting. They never simply go by our profile. They want the proof of the each and every profile. They want the certificate of the each and every partner, whether he is really qualified, whether he has that much of experience for empanelment. So what I suggest, primarily, if you want to be a stock auditor, first thing is, whatever information, correct information that we should keep it in our hand. With that information, we'll have to upload into the respective bank's portal to empanel our firm for the stock and receivable audit. Then credit monitoring department at a head office level will recommend to various zonal office. So this empanelment process and filtering and the listing out the eligible stock auditors are finalized by the credit monitoring department, which is situated at the head office. Finally, they will prepare the list. That list, they will share it with the respective zones depending upon the number of stock audit assignments available in the respective zone. Then in turn, the zone audit zone only, they will allot the stock audits to the respective stock auditor list provided by the credit monitoring department. So our institute has given the guidance note on the audit of inventories, wherein it says the guidance note deals with the procedures deals with the procedure of the auditor in respect of audit of inventories. It outlines the peculiar features of inventories which impact the audit procedure. So important aspects of audit of inventories. What are the importance are? Number one is internal control evaluation. So internal control evaluation is the foremost important for a stock audit. See, many of us think that stock audit means only physical verification. And we immediately will go to the factory and count what are the different quantities are there and report it, whether it is shortage or excess, all these things with that. I would say this, the responsibility of we are the financial professionals. That we have to keep it in our mind. We are only a financial professional. We are not a technical professional. Because the stock audit, it is a composite of the financial as well as the technical. So if you take the diamond industry, if you are appointed as a stock auditor to value of the merchant who is dealing the diamond, in that case, so your knowledge is not sufficient. Necessarily, you will have to engage the another profession who is well versed with this diamond field. Similarly, so when you are asked to value the some high projects, quite substantial value of the projects, construction projects which are involved, so wherein you will not be able to ascertain the value. For that, you will engage the architects. So like that, so first let us understand what is our limitations, to what extent we can give our quality and our assurance in respect of the assignments which we are shouldering. So if any information of any certification nature which is beyond the financial aspects, what I suggest, better you give the disclaimer stating that we are not a technically competent person to comment on such things. Because if you give any certification without understanding the ground reality of the particular situation, definitely we will be, unless we are shouldering the responsibility. So the foremost important of the stock audit assignment is to understand and evaluate the internal control mechanism. So when I'm saying that internal control evaluation, so first foremost thing is, as I told you, that the stock audit assignment, it is not only confined to the physical verification of an inventory and evaluation of the inventory on the date of the visit. We are supposed to go through the 1 year track record of these stock statements which are submitted to the bank. So whether the stock statements submitted to the bank, from where they get the information, whether the stock statements are really is an outcome of the database which are from where they have derived the information, or they have some cooked up the figures on month basis and submitted to the bank. So what is the internal control management is available with the company for periodical submission of the informations to the bank for their evaluation. So this is foremost important. Similarly, the physical, raw material control management. So what are the software, whether they have integrated software to link with the physical movement of materials vis-a-vis the financial records. On the other hand, if there is a standalone software, they maintain one software for the inventory, another software for the financial records, then there is a reconciliation between these two, that itself very cumbersome exercise. Then it will not give the true picture at any point of time. So like that, so the foremost important of a stock auditor is to understand the internal control mechanism which are exist in the borrower premises, whether it is adequate, commensurate with the exposure and the level of the inventories which they are holding and they are reporting from time to time. Then next one is the verification. So while verification is in the form of carrying out an audit of an inventory, the auditor is particularly concerned with obtaining sufficient appropriate audit evidence to corroborate the management assertions regarding the following. So evidence is very important. I come across many instances wherein during the course of physical verification, the party, he would have told us that, sir, this is how it is. But based on that, if we conclude and as a result of the outcome, it is drawing power is insufficient or overdrawn, then when we report it, then borrower immediately they will revert it. They will say, no, there are the stocks which are available elsewhere. Your auditor, he fails to verify. Like that, they try to protect their circumstances. So that is the reason the auditing evidence is more important. So physical verification coupled with the auditing evidence to substantiate what we have seen, what we have verified. So each and every document which is submitted by the borrower, you have to ensure that that is being vetted by the responsible officer of the borrower. Is very much essential. So these documents only will speak at the later end, because we do not know when we go for this physical verification of stock, whether the stock was physically seen by us or not. There is no evidence unless you have some sort of documentary evidence or the by way of the photo capturing the photos or the video footages. So it could help us to substantiate our stand and decisions, so which we have taken on the particular instance. So number one is the existence, that all recorded transaction inventories exist as at the year end. That is the time at which we undertake this audit. So whether the inventories are in existence first. Then second one is the ownership, that all inventories owned by the entity are recorded. First point, because we come across a situation that even if you take these big companies, the stocks may not have booked into the factory. So it is in between, because there is a quality check. The stock is received and lying at the quality check. Once the quality check is complete, after that only they will prepare the GRN, then it will go to the inventory. So what is the time gap between this? So to that extent, whatever stock lying in the factory, has it been accounted for? Because when we are doing this physical verification of the stock, the demarcation of the stock which is not belongs to the company, that is the foremost requirement. Because we come across many various places where there is a shuffle of the borrower stock vis-a-vis the other stock also is happening. For example, a borrower who is dealing the job, who is getting the job contract, job work, wherein the materials are being supplied by the customer and they'll do the job work and they'll send it back to the customer. It's only value addition. On the other hand, they get this order for the sale of the components or the goods for which they procure the raw material, and they will do the processing and they will send it back to the customer places. So there are two types of stocks which are lying in the factory. So now the demarcation of the stock belongs to the somebody else. It is intended for only labor. Then these materials which are owned by their factory. So this demarcation is very much essential at the time of the verification of the stock. So furthermore, there are certain items which would have, the borrower, you would have sent it out for the further processing. So whatever stocks which are lying outside the premises of the borrower, what is the control mechanism? What is the documentary proof which are available with the borrower to substantiate the quantity of the stock which are lying, inventory is lying in some other places? That all these things are to be looked into it to ascertain who is the ownership of the inventory, whether we are doing this audit confined only to the inventory which belongs to the borrower. Even there are instances we come across, the borrower, there are certain raw material, unless otherwise they pay advance, so they will not get the inventory. So in such a situation, the transfer of ownership, when it takes place, whether the transfer of ownership is taken place the moment they dispatch the goods at their factory or when it reaches the borrower place. So depending upon the contract between the supplier and the borrower, so the ownership also will undergo changes. So whether all these things are properly taken into the consideration while determining the inventory, so whether there is a proper approach is being made by the borrower with reference to the identifying the inventory ownership of the inventory. So that is to be calculated. The next one is the third part of the stock audit is it comprises of the valuation. Valuation plays a major role. So what is the manner in which the stocks are to be valued, inventories are to be valued? So there are various types of valuation for various purposes. So for the purpose of the bank, what are the items to be included? What are the items not to be included? What are the expenses to be included? What are the expenses not to be included? So moreover, so it is not an templates where the one set of procedure it is being adopted for all. Certainly not. So one is the our accounting standard which talks about so what is the cost, how you will determine the cost. If it is a cost as an inventory, it is a revenue item, how you will determine. If it is a capital item, how you will determine. So one is the by way of the compliance, statutory compliance by issued by our institute by way of the various standards. So second one is the customary practice available in the industry. So each and every industry, they have their own set of the procedures for determining the various expenses as a cost, attributable to the cost. Then third one is there is separate situations under which the company is running. So that cost also will undergo changes. So these three factors are to be considered when determining the valuation of an inventory. So one is the compliance, statutory compliance. That is the our institute or other central government or other regulatories which they have issued to determine the cost of an asset from time to time. That is to be taken into consideration. Second one is the industry, the customary practice. Third one is the company's present setup, how they are handling these particular items. So all the three factors are crucial to understand to determine the valuation on the inventory. Then, so our commencement of a stock audit, so it has to be commenced. One is the pre-commencement, physical verification of inventory. So before, at the time of pre-commencement, we understand about the entity. So the entity, first brief about the entity is very much essential. So always there is a slogan, they used to say, see, if you want to cut a tree, before you cutting the tree, you sharpen the axe. So then you will take the very little time to cut the tree. Similarly, understanding the entity is very much essential before we take up this stock audit. Then once we understand about the industry and the entity in which the industry it falls, then accordingly we could plan our audit based on the our yearly access, our knowledge. Then next one is there is a substantial procedure. We'll have to lay down the various procedures that through which we will have to conduct the stock audit. Then the last part of the our stock audit assignment, it comes by way of a reporting. See, I would say the highest challenge for a stock auditor is to reporting. As I said in the earlier of my beginning of my remark on the stock audit, so we might have done this excellent stock audit exercise. Then we have pointed out a lot of serious lapses happening in the borrower account. When we are reporting in our report, what will be the outcome? So here the appointee is nothing but the zonal audit. So when we when we go and submit the audit, what will be the reactions? Whether they will take it in a very positively, otherwise they will ask us to revise the audit report. So this kind of situations are very common. Even we come across, I hear a lot of instances where the stock auditors are always under threat. The zonal management, they used to tell whenever you give the adverse remark in the stock audit, they'll call and they will discuss. You change this particular clause, you remove the clause. If you don't do it, we will not allot the another audit. Henceforth, you will be blacklisted. See, these people are committing a lot of frauds and crimes. But when we are pointing out, they have appointed us only to find out the lapses and mistakes happening in the process. But if you find out the mistakes, then you will be cornered. But whatever it is, my personal request to our chartered accountant members is that don't budge by all pressures and tactics. See, what they could do, worst come worst situation, so they could they will not allot the further audit. Doesn't matter if they don't allot this audit to me, they will allot to my friend. That's it. There they go. So like that only. Then they could delay in crediting my fees. That's it. Only they could do only these two. Because of these two things, we cannot compromise in the quality of our comments. So we'll have to be very careful in dealing this audit, and the reporting is the foremost important. So whatever lapses we come across during the audit, so while reporting, you have to ensure that you should have this documentary proof to substantiate the negative comments when we report it in your reporting system. Then there is a checklist before commencement of the audit. So one is the appointment letter. Nowadays, all the appointment of any types of audit is coming only email. Email such an extent it is being used. So appointments are coming by way of emails. You'll have to take the copy and you have to keep it on record. But better you go through the appointment letter thoroughly, because that is important. Because in the each and every appointment bank, they follow the different strategy. The scope also will undergo changes. Because I would say this, many banks, the fees fixed for the stock audit is 5,000, 10,000, inclusive of travel expenses. So with this penury of this fees, is it possible for us to take up such a responsible assignment? So what is the time frame? So what is the management expectations? All these things have to be looked into very thoroughly and understand what is my role. To what extent I can play. So what extent I can lay my hands. So all these things are very much essential before we taking up this audit assignment. Then communications to the borrower specifying the particulars required to do stock verification. See, once we receive the appointment letter, once we understand what is the scope, what is the management expectations and our responsibility and roles, then communication based on to discharge the stock audit assignment. So what are all the documents we are supposed to be looking to it? So that will listing out in a covering letter. You send it to the borrower through branch. That is foremost important. Many circumstances, what happens to the branch people? So when we say, sir, we have been appointed as a stock auditor, we are going to comment. They'll say, fine, sir, you comment it. Sir, we will send a arrange vehicle, we'll inform the borrower, you go straight away, you can, we'll tell them. But my personal request, suggestion is that don't go alone, because we need one witness from the management. Because if anything goes wrong, so that somebody, the bank representative, definitely he will be a witness. So he cannot change his term. So definitely, as far as the stock audit is concerned, it is such an important assignment which it decides the fate of an account. Even as an outcome of a stock audit, many standard advances is split into a non-performing asset. Many standard advances, there are many fraud cases are being filed as an outcome of the stock audit assignment. So such an important report on which we are doing this assignment. So you ask the branch people to accompany with us whenever we go for an audit. So before you take up an audit, the list of our requirements. So you tell them to keep all the records ready at the time of our inspection is very much essential, so that we could save time while taking up an audit. The branch visit for discussion with the head of and obtain sanction ticket copy and copy of the review of the files with respect to periodic statements to be obtained as per sanction terms. So I would say this, before you go for unit inspection, first let us sit in the branch and understand let us go through thoroughly the file of the borrower. So what is happening all along, that is most important. So to start with, latest sanction letter. So that will do checkup. When you call for the latest sanction letter, we come across a lot of ambiguity even in getting the sanction letter. The sanction letter they would have issued in 2019. After that, they would not have renewed it. But in the system, they would have simply changed the date as renewed. So this kind of situations also is happening in the banking industry. So foremost thing is where is the latest sanction letter? So whether the sanction letter is in order, whether the sanction letter is issued within 1 year or the sanction letter is already the sanction period is 12 months is over, whether the facility is renewed or not renewed. So all those things plays a vital role to decide the fate of a particular borrower. Further, so the terms and conditions specified in the sanction letter. So when I'm saying this terms and conditions are broadly bifurcated into two. So one is the pre-disbursement, another one is the post-disbursement terms and conditions. So pre-disbursement terms and conditions, before disbursement, what are all the conditions are to be complied with? So whether all the conditions are being complied. So as I said that the stock audit, the minimum threshold limit is 1 crore. It's fixed by the RBI. So normally this 1 crore type of advances, the banking industry, they have a policy of vetting of documents. So vetting of document, other pre-release audit. Each and every bank, they follow the different nomenclature. So whether depending upon the bank practice, see if they say that pre-release audit is conducted, whether the pre-release audit is really conducted, when it was conducted, what is the outcome of the pre-release audit. So if it is vetting of document, whether it is being done, all these things are to be looked into. Then further post-disbursement. So post-disbursement is, when I'm saying this post-disbursement, the foremost responsibility of a concurrent auditor is to check the end use of funds. So when I'm saying this end use of funds, what happens, so whenever the facilities are being dispersed, there is the practice of transferring the cash credit exposure by transferring it to the current account. So what they will do, they will debit the cash, assuming that 2 crore facility is sanctioned. So what they will do, they will debit the 2 crore account. Correspondingly, they will credit the current account. So the bank is playing game by opening the current account, because one hand, so they get this exposure advance portfolio on the higher side. The another hand, so there is a credit balances in the current account. As a result, the cost of position also it is coming up. So at the cost of the innocent or ignorant borrower, the bank is enjoying the both sides. This is one kind of window dressing. If you come across such things are happening in the bank, so you have to ask what is the necessity for a borrower to maintain a current account when the bank is providing the cash credit facilities to the borrower. So what is the difference between the current account and the cash credit? So cash credit is much larger than the current account, isn't it? Current account, it is an operating account. So cash credit also is an operating account. So there is a dual role as far as the cash credit account is concerned. One is cash credit. When the account of cash credit is opened, through this cash credit account, the working capital facility it is being dispersed. So this cash credit account, it is a means through which the cash disbursement of cash credit facility is being made, working capital facility is being made. Second one, it is a regular operating account. If that being the situation, what is the necessity to have a current account parallelly when the cash credit facility is provided to the borrower? So this point also to be looked into it by the auditor, and suitably it has to be brought into our report. Then further, another important scenario which is happening, lot of diversions or takes place in the disbursement of cash credit. So here, when a borrower maintains the cash credit facility, he is permitted to maintain the current account with some other banks. So the banker also least bother about all these things. They once a facility is sanctioned with adequate security, property, other things, they least bother whether he maintain current account in any other banks or not. So this is one of the main reason for the diversion of funds which are happening through the cash credit facility. In fact, RBI is issuing the circular one after another, pointing out these irregularities in opening the current account. In fact, they issued a circular, opening current account need discipline. RBI categorically, it has stated that when a borrower enjoying cash credit facility, he is not supposed to maintain current account elsewhere in any other bank. Even the same bank also he is not supposed to maintain. In fact, this circular they have issued such a stringent circular in somewhere in August 2020. When they issued this stringent circular in August 2020, they said that so this compliance to be strictly followed by the bank. Whoever be the borrower maintains the current account elsewhere, within 3 months, the borrower asked to close the current account. So this was the scenario. So the RBI has given a 3 months time notice, but subsequently they have extended because of the corona and other things. Again, they have extended. But the crux of the point is that the RBI is very much against the maintaining the current account with some other bank. So if you come across during the course of audit where the borrower maintains the current account elsewhere and quite substantial funds are being diverted to the current account, that also to be pointed out in your report, because this is one of the major, because see, as I told you, when you say the stock and receivable audit, our responsibility, it is not only a valuation of the stock, a valuation of the inventory, it is a technical in nature. We are not 100% competent as far as the valuing of an inventory is concerned. There are so many intricacies are involved. But we are being a financial professional, we shall not err in commenting the financial related activities. So this diversion of fund, misutilization of funds, it is squarely, it falls under the responsibility of the stock auditor. We cannot take under the any protection of any other reason, excuses. So I would say that we'll have to give more emphasis on the end use of funds, the purpose for which the fund is used. Is there any diversion of fund? Whether the party maintains the current account elsewhere, or whether he do the cash and carry business. In such a situation, whether all the cash sales are being accounted or being accounted at the end of the day. We see when you ask the branch people, when you go through the cash credit account where the credit summation is very poor, while comparing the turnover projected by the borrower, the bank, they'll try to protect the borrowers, stating that, sir, the cash and carry, so they used to sell it. A textile merchant, he used to sell it at the cash counter. So all the cash entries are not being reflected. But that is not the case. The principles of the cash credit facility is that even though the cash sales are happening, end of the day, the sale proceeds are to be deposited into the bank. Then after that only, for whatever cash requirement to meet the expenses, he has to withdraw it. So this is the fundamentals of the cash credit facility. But if the banks are not doing it, so definitely this point also to be brought into the our report. So as I told you, the terms and conditions which are bifurcated into two. One is the pre-disbursement, another one is the post-disbursement. As a part of post-disbursement, we are supposed to check is there a use of funds, the purpose for which the facilities are being sanctioned, whether it is being used. First point. Second point, whatever be the other compliances, periodical reports and returns which are required to be submitted, has it been submitted? Whether the genuineness of the reports which are being submitted, all these things are to be looked into it by the stock auditor. Then the next point is that, so there are certain list of details that are to be collected from the branch. What are the list details to be collected? One is the copy of the latest sanction ticket. Second one is the current stock, debtors, creditor statement with aging breakup of less than 30 days and 60 days and 90 days and others. Here, see, when I'm saying this copy of latest sanction ticket, So copy of latest sanction ticket, when I'm saying that, each and every sanction letter, it has to be acknowledged by the borrower. I would say this quite majority of working capital facilities enjoyed by the borrowers, the acknowledgement of the sanction ticket from by the borrower not happening. So this is one of the main lapses on the part of the bank for getting the acknowledgement in the sanction ticket. Why I'm saying is that the sanction ticket is if you take what documents part of the working capital facility. When I'm saying this list of documents at the part of the working capital facility, which document is the first? Can you tell me which document is the first as far as the cash, any facility for that matter? The first foremost document is a sanction letter, because proposal, all these things and all is before sanction. It is only a proposal. But once there is a relationship of the borrower and the lender, it comes into existence from the sanction ticket. So this is one of the foremost document. So whatever understanding devised by the bank, that has to be acknowledged by the borrower. I would say even there are certain lapses in the documentation, other documents. See, the DPN not obtained, or the hypothecation agreement, there is issue like that. So that is not secondary. The foremost thing is a sanction letter. So sanction letter only, it gives it is a Bible of the role and responsibility duties of a borrower. Whether all these things are properly acknowledged is very much essential. If it is not acknowledged, this is also one of the points for our comment. Then copy of past 12 months stock statements and drawing power statements given to the bank that will have to collect. As I told you, your stock audit, it is not confined to the only the time at which you are conducting the audit. It is in law, our responsibility goes back to 12 months before we commence the audit. So when I'm saying that the stock statement from previous 12 months, so one information for which we need not struggle, we need not put lot of efforts. That is the stock position as on 31st of March. 31st of March, always the responsibility of stock auditor is to compare the stock disclosed in the audited financial statement of 31st of March vis-a-vis the stock statement given to the bank as of 31st of March. I would say this invariably not even 1% in tally. You come across a situation, value of the stock inventory in the balance sheet is less, value of the inventory in the stock statement is more, value of the debtor in the balance sheet is less, value of the debtor in the stock statement is more, then the value of the trade creditors in the balance sheet is more, value of the trade creditors in the stock statement is less. So totally ulta. So it is happening. So that being the situation, it is a very handful information because it is duly attested by another fellow chartered accountant. So we could rely on that information. So whenever there is I would say whenever we take up this exercise, we will end up in a quite substantial variations. So invariably there will be a variation. So whenever such variations are happening, so definitely you have to ask clarification through the branch of why there is a gap. So if they are not able to give the clarification, definitely they will not be able to give the clarification. We know very well. So the value of the stock, it is nothing but a hidden profit in the balance sheet books. So that is the situation. So if they are not able to give the proper clarification, that also to be brought into our report. Then copy of the latest insurance policy with bank name for the transit insurance wherever applicable for delivery of goods at site. Then copies of the last three QIS statement, that is a quarterly information system. So quarterly information report, wherever the bank is required to obtain, they would have mentioned in their sanction letter whether they obtained it on quarterly basis. So whether they have obtained, and that also to be checked. Then copy of the last 3 years audited financial statements with IT calculations, a copy of the IT returns, that also to be obtained, and we will have to keep it on our reference, because our stock audit report always they used to compare with the previous year and vis-a-vis the current year trend in the gross profit trend, the business growth, net profit trend. So all these things they will insist the concurrent stock auditor to comment. For that purpose, this previous 3 years of audited statements is very much essential to give our report. Then constitution of firm, breakup of present shareholding and details of shareholding in other firms, companies and their bankers, all these things are to be commented. Then details of statutory bill payments pending, if any. So in case of any PF dues, ESA outstanding, GST outstanding, or income tax dues. So all these things we are very much essential on the part of the concurrent, on the part of the stock auditor to comment in his report. So we'll have to call for the latest challans on the payment to the PF authorities, ESA authorities, and the GST, and any other statutory remittances which are to be made by the company has it been made. So that proof also to be corrected. And details of the sales returns for the past 3 months along with the mode of settlement, either by credit note or supply of fresh goods. So whenever the goods are returned, what is the mechanism? So whether they are giving it by way of the credit note or by way of the replacement by way of some other goods, what is the procedure? Whether the proper documentations are being made. So there is a proof of the documents of such transactions are to be called for. Then we should know what is the installed capacity, what is the lifespan and the working condition of the each and every machineries in the factory. So if the machineries are obsolete in very outdated machineries, so it really needs to be replaced. That also to be looked into it by the stock auditor whenever we take up an audit. Then CA certified book date statements if applicable. So whenever the receivables are offered to the bank as a part of determining the drawing power, generally the banking industry, they will insist the receivable statements duly certified by a chartered account on quarterly basis shall be submitted. But unfortunately, many borrower accounts we come across where even though this condition is stipulated in the sanction letter, the bank, they never take any efforts to collect the receivable statements on quarterly basis. So in such a situation, that also to be brought into in our report. Then last 6 months bank statement to understand whether the facilities are being used for the proper use or is there any misutilization of facility. And name of the accounting software being used, whether it is their own soft or any ERP developed. So all these things are to be collected and they will have to keep it for our further perusal. Then the details of the purchase sales with associated companies along with the pending payments. Then details of monthly sales achieved during the current financial year. Our institute, they have issued certain guidelines. So with reference to this inventory audit. So here our institute guidance note and the standard prescribed for this stock audit, the auditor should conduct the audit based on generally accepted accounting practices and to the best of his judgment and ability. So a reference to the following pronouncement of the ICA could be used. One is the guidance note on audit of inventories. So the next one is the Ind AS 2 evaluation of inventories. Ind AS 18, the revenue recognition. So these are all the pronouncements which could help us to give the quality in our stock audit. So there are, during the course of audit, what is to be done? The requirements are to visit the various places of storage of stocks, including stock lying outside location, and verification the stocks physically and reconcile the same with the records of the stock statement submitted by the company as on the date of the visit. So when I'm saying this is a stock audit, it is not only confined to the factory owned by the company. More than that, wherever the stocks, as I told you that where the subcontractor, where the stocks are sent outside for this further processing. So in such a situation, we are supposed to go to the various other places where the company stocks are laying. So before we take up this audit, first we'll have to call for an information. So wherever there's the company stocks are laying. So we will take the list of the places where the company stocks are laying. It is whether it is owned by the in the controller of the borrower or they are given it for the job work. So based on that, you'll have to take the checklist. What are the aspects to be looked into when it is lying in the subcontract phase, or if it is in the company own store yards or the warehouses. So what is the arrangement? If the warehouses belongs to the company or it is so they are hiring this warehouse facility, all these things are looked into it. So accordingly, so what is the flow of documents whenever there is a movement of stock between this factory and the warehouses or the some other third party places are to be looked into, and so documentary proof are to be kept in record. In fact, I had an opportunity to conduct a stock audit for Bank of India. In that one EPC, Sriram EPC. So that company, a stock audit was assigned to me. In fact, that company is under the consortium arrangement, whereas we may, lot of banks are there, of which Bank of India exposure is one such bank under the consortium arrangement. They asked me to do the stock audit. You don't believe this Sriram EPC, they does the capital projects. So capital projects, I was expected to go to this Andhra Pradesh in one place where the cement factory, so they have under the control. So I supposed to visit the cement factory in the Andhra Pradesh, I think next to Guntur. Then I visited the place and I supposed to value the value of the factory which are under construction. Then I had to go to the another place in the south of Tamil Nadu where the solar energy where the company is developing. Then another place I supposed to go to this Delhi where the company is undergoing the drainage system, underground drainage system. So like that, there are two total different dimension of activities are happening in the industry. When a stock auditor, when we are appointed as a stock auditor, which is small fees of 25,000 or 30,000, when they are asked us to go to the pillar to the post, and that was such a capital projects where we are supposed to value and comment, is it possible? Do we have that much of technical knowledge to do it? Whether in the appointment letter, whether they have given the permission to engage the technical experts to assist and give the quality of our audit? Nothing. Simply they are given on a stock audit, you will have to go and do the audit. So under these circumstances, so we'll have to confine our role only as a financial profession. So whatever areas which reference to the financial related activities, only those things will have to be brought into our report. Other such as technical issues, definitely we cannot comment on these technical issues. So further, there is no permission or the given by the bank management to engage the technical experts to ascertain the value of certain things. So we'll have to give the disclaimer. So why I'm quoting this situation is that we should draw our line to what extent we can go, to what extent we can confine our responsibilities very much essential as far as the stock audit is concerned. Otherwise, without knowing, if you simply for report, if you say yes, no, one day or other, if any problem arises, immediately they will catch hold of the stock auditor. So much of responsibility is attached to the stock audit. That too, so now the banking industry, so they are not giving so much of emphasis in the stock audit. Quality, I would say the quality in the stock audit. Rather, it is by and large, it is happening as a customary of a report. So they keep a report in the records on year after year, so that their exposure, their decisions are being substantiated or justified. But if you go with them, if it goes against at one point of time, we are irresponsible. Because as far as the bank management is concerned, they know they have a very big setup. They know how to protect themselves. So various ways and means. But we are the poor auditors. Even we will not have the money to engage one advocate to substantiate our situation. So under these circumstances, please you play very safe. First, you understand your scope and what are your limitations. And according to your limitations, you do the audit and comment in your report. Wherever areas which are not confined to you, wherever which is not within the financial professional responsibility, please you be frank in disqualifying in your report. That is very much essential as far as the stock audit assignment is concerned. The next one is to compare monthly stock statements submitted by the company during the reference period with the stock records maintained by the company, and point out the discrepancy if any noticed. Then counter check sales purchase records maintained by the company to verify the reasonableness of the movement of stock records maintained by the company. Then to comment on the valuation methods adopted by the company for valuing the inventory, like a FIFO method or LIFO method or average cost method or weighted average method. What is the methodology they are following? So that is to be commented. To comment on the correctness of valuation of raw material stores by scrutinizing invoice copies on sample check basis. So for each and every items which are mentioned in the stock in the inventory list, you take on the ABC analysis. On the big value items, whatever be the cost which they have mentioned, whether it is substantiated by way of the bill. So you call for the supplier bill to substantiate the cost which they have adopted for valuing the inventory. And to comment on the system of inventory control, average holding of inventory levels vis-a-vis norms and optimum level accepted by the bank. Inventory shall be measured at the lower of cost and net realizable value. So for the purpose of valuation, always it is our accounting standards is very much clear that so it has to be valued either cost or realizable value, whichever is less. The cost of inventories shall comprises of all cost of purchases, cost of conversion, and other costs incurred in bringing the inventories to their present location and condition. So, then what is the cost of purchases? What are all the components to be liquidated for the cost of purchase of the raw material? So, one is the cost of raw material as per the invoice. Then whatever expenses which are incurred to bring the raw material into the borrower place, all the costs are to be included for the purpose of cost of purchase. But if there are certain expenses which can be reimbursed, which can be adjusted, for example, for example, a GST component where which is included in the invoices while supplying the material by the supplier, but the borrower, he will be taking credit on the input credits. So for the purpose of valuation of raw material, whatever be the GST component which is going to be used as an input, that needs to be excluded. But on the contrary, there are certain GST component, so for which they are not able to take a credit. I'll give you an example. The company is recently started. There is a delay in getting the registration. But before registration, lot of purchases are taken place. So while receiving the purchases, the GST components are inbuilt in the purchase of materials. Whereas GST number of the borrower is not mentioned. When GST number is not mentioned, then the borrower, he cannot take an input credit. In such a situation, so that GST component can be included as a part of cost. So the cost of purchase of the material is a main factor to determine how the cost is being determined. What are the factors they are looking into it? So is there any formula? Is there any checklist through which they are arriving the cost of purchases? That also to be looked into it. Then next part is the cost of conversion. When I'm saying the cost of conversion, so the raw material, it is undergoing the machining process. So when it's undergoing the machine process, various stages. So each and every stages which is fall under the conversion. So what is the conversion factors? What is the expenses which are incurred by the company? So for the conversion process, for that the company, they should have the cost matrix for the each and every machine. What is the time duration for the processing of this each and every item? Then so what is the cost involved? What is the hourly charge cost on each and every machine when it runs? So this cost sheet is very much essential. They should keep the record of the cost sheet for the each and every machines which are under the use of the production. So now this cost audit is come to our handy for determining the conversion cost. So whether the company falls under the cost audit mechanism. If it falls under the cost audit mechanism, then definitely cost audit report will have to call for. So in that cost audit report, is there any comments? Is there any, whether internal mechanism, whether they have comment on the internal mechanism? Is there any comment on the costing of the each and every machines? All these things could be looked into to ascertain whether the cost of conversion is properly taken into the account or not. And the major part is under the inventory valuation is the byproduct. So invariably majority of the processing activity is resulting in the two types of products. One is the main core product for which the company is running. Second one, there is an incidental, so which cannot be avoided. So that is the byproduct. So whatever be the outcome of the byproduct, how it has to be dealt with in determining the cost is a foremost scenario whenever we take up a stock audit. So the most byproduct by their nature are immaterial. When this is the case, they are often measured at net realizable value, and this value is deducted from the cost of the main product. So here we are saying that whenever a steel rod it is being used, so that steel rod it is being converted into the components. So initially when I am inserting a steel rod weighing this 100 kgs, then when it comes out, so I will get only 95 kgs. The remaining is coming in the form of scrap. So even if it is in the scrap, if it is in the form of scrap, if you value this resulting of the component of 95 kgs, then the scrap, value of the scrap, it will not match the 100 kgs. Definitely again, there is a loss, production loss. So whatever be the outcome of this scrap, so what is the realizable value of the scrap? To the extent of the realizable value of the scrap, that will be adjusted against the cost of the purchase of the raw material. 100 kgs. 100 kgs cost that will be converted into the 95 kgs. So like that, so whatever be the byproducts, which are essential form part of the integral part of the conversion process. So the resulting byproduct, what is the realizable value of the byproduct? That value is to be adjusted to determine the original cost of the product which are coming to as a finished product. Then there are other expenses or overheads which are integral part of the process as to come into the final shape. All the expenses are to be included. So I need not to give any elaborate on this aspect, because we are all know very well what are the expenses which are part of the production, what are the expenses which are part of the administration nature, what are the expenses which are of the selling nature. All these things we know very well. So whatever costs which are essential for conversion, all the costs are to be brought into the account for the purpose of determining the final product. So, but there are certain expenses which cannot be, which needs to be excluded, which shall not be considered. Example, the cost excluded from the cost of inventories and recognized as expenses in the period in which they are incurred. One is the abnormal amount of wasted material, labor, or other production cost. For example, so when I am inserting the 100 kgs of the rod, I supposed to get 95 kgs in the form of 95 components. Due to some defects in the material, instead of 95 finished components, I am getting only 90. Whereas the 5 components which are in defective due to the labor inefficiency or the machine inefficiency or the raw material issues. So all these things are resulting in a 5 components which is a defective. Now how you will handle the 5 components? Now the cost you will equate with this 90 or 95. So here this is an it is not an integral, it is not a part of the byproduct. It is due to the certain extraneous circumstances because of the inefficiency in certain areas. As an outcome of this inefficiency, these defectives are happening. So defectives also to be treated as a part of the main component and the value to be arrived. So that the value of this defectives, it has to be separated separately. But for the purpose of value of the finished goods, how to determine the cost of the finished goods. So whatever value cost which are incurred for this 90 products, same conversion to be applied for these 5 products also. Then storage cost, unless those costs are necessary in the production process before before a further production. So storage is one of the very critical situation where the storage costs are to be included or not to be included. So if you take this that is corona vaccine manufacturing company, where they are in the process of manufacturing, when it undergoes various stages, when it is the first stage, before when it's moved to the second stage, they necessarily have to keep it in the storage. So that storage is an integral part of conversion. So such storage cost needs to be included as a part of component outcome. But on the other hand, when the storage happening, once the item is finished, at the time of dispatch, until it is a dispatch taken place, we are keeping it in a separate cold storage. Or in a way, these storage expenses are not to be loaded with the cost of the item. Because this storage cost, it may vary depending upon the demand and supply. So whenever there is a demand, I need not keep it in the storage. Immediately I'll send it to the respective user's hand. On the other hand, if the demand is not there, I am under compulsion to keep it in the storage. So the storage cost is a very important in the nature, whether it needs to be included or need not to be included. Depending upon the industry and the company process activities, it has to be decided. Then administration and selling expenses, we know very well it is not a form part of the cost of an outcome product. Then another important situation is the treatment of borrowing cost, whether the borrowing costs are need to be included or not to be included. Again, the lot of debate and a lot of situations under which the decisions are to be taken. So if you take this Ind AS 23, wherein it says the borrowing cost identifies the limited circumstances where the borrowing costs are included in the cost of inventories. So whether the borrowing cost is included or not to be included. So here the borrowing cost is literally cash credit interest. So whether the cash credit interest to be included or not to be included. So that is the point of the issue. So the EDIS 23 is very much says that depending upon the circumstances where it is essential to include the borrowing cost as a part of inventories, then you include it, otherwise don't include it. So further it says that an entity may purchase inventories on deferred settlement terms. So inventories are being purchased upfront basis, payment is made. Then, so there is a financial arrangement with the bank. So with the deferment system, the payments are being by way of various installments. So this there is a cost for the deferment of the payments. This cost whether to be loaded or not to be loaded. So further it says that in that purchase inventories on deferment settlement terms when the arrangement effectively contains a financing element. That element, for example, a difference between the purchase price for normal credit terms and the amount paid is recognized as interest expense over the period of financing. So here the nutshell of this para is that, see, I have an credit period arrangements with the supplier. So when I am having a credit period with this arrangement with the supplier for a period of 60 days, so he quotes a per item at the cost of 2,000 per kg. Whereas if I go and pay on the cash and carry basis, so he's satisfied with the 1,800 rupees. Now this 200 is the factor for the instant payment. Otherwise, the 200 is the interest factor for the delay in payment of 60 days. So whereas if I'm going into the bank arrangement, the bank is prepared to offer a finance. As a result, I will make the upfront payments to the supplier at the rate of 1,800 rupees and I will buy the product. Whereas I have commitments to the banker, so I will make a payment at the end of this 60 days. But there is a financial cost attached to it. The financial cost is 100 rupees. Now in this process, I am gaining by 100 rupees per kg, isn't it? Because if I go for the credit period with the supplier, 2,000 rupees per kg for 60 days credit period. Instead, I am going with the cash on carry basis at a discounted price of 1,800. Where since I don't have the money, I am having the financial arrangement with the bank for 60 days of LC or any other financial arrangements. So the cost for this 60 days is 100 rupees. Now I am gaining 100 rupees. Now, so this is an integral part of a cost, because if I am entering into an arrangement with the bank, I will be ending up in a loss of 100 rupees. But if I continue to have the credit facility with my supplier, my cost of the product will go up to by 100. That is my cost of the product is 2,000 rupees, isn't it? So this kind of an arrangements, if whatever be the cost attributable for purchase of any component, that can be included. But if it is purely of the financial nature, then such expenses cannot be included. Then comment on aging of the breakup of the stock and identification of the stock of obsolete, slow moving nature, checking the quality as well as the quantity of such stock, and commenting on their saleability and realizability is very important. So when I am saying that, comment on the age wise of stock. Is there any age period for the inventory? Because if you take this company which is manufacturing of steel, so the steel which bought about 2 years before it, that can be used. Whereas if a company who is in the aquamarine, so the life of the stock is very limited. So depending upon the industry in which the company carrying on the activities, the age of the stock will undergo changes. So for here we need an expertise understanding of what is the lifespan of the inventories which are being in the company. So, so if you could get it from the Google source, or if you need certain information where this specific technical expert knowledge is required, definitely we can seek the technical expert knowledge. Otherwise, it's better you give the disclaimer on this, because this is the area you cannot lay your hand. We do not know the chemical life. So if it is the chemical in tablet manufacturing company, but when it is an outcome as a tablet, there is an expiry period. So with that expiry period, we can say this expiry period is already over. So, but still it is in the stock. The company is disclosing as a stock. But if it is in the form of chemicals, what is the conversion period of the chemicals from one process to another process? What is the age of the conversion? Who will know? What is the factor? So for these things, only the technical experts could give the correct view on this. So we cannot, unnecessarily, we cannot involve all those things. Better wherever technicality in nature, don't involve yourself. Give a disclaimer on such things. So ascertaining the identification of the obsolete and slow moving stock, very old age stock, all these things falls under the certain special knowledge. So if we have this adequate knowledge out of our experience and practice, fine. Otherwise, please you be crystal clear in your understanding by disclaiming the your comment. The next one is the to look and comment on the system adopted by the company for policy of procurement. What is the company policy on procurement policy? So is there any agreement on the procurement policy? The movement of stock from stores. What is there any policies there? Then bin card system if adopted for management of the stocks. All these things ought to be looked into it whenever we take up the stock audit. Then to comment on the general storage conditions for stocks, procedures adopted for testing and inspection and quality control, etc. So when I'm saying this, comment on the general storage, we come across a lot of issues, where the stocks are lying in the open yard. So where the steels, when it is kept in the open yards, during this rain season, it will be a corrosion, subject to corrosion. When the factory is situated near to the seashore, so the salt corrosion also, it will undergo the quality of the steel. So like that, whether there is an adequate security mechanism is available to take care of the raw material. Even if you take this certain cotton industry or the textile industry where the yarns are being not kept in a proper closed place. When it is kept in the open place, then definitely the quality and the usability, it will undergo very fast. Then comment on sales, returns, rejected stocks of finished goods, ascertaining the reasons therefore, and also the measures being adopted by the company for disposal of such rejected stock. So if you come across very often sales returns are happening, if you come across very often purchase returns are happening, it indicates that there is an inherent weakness in the quality control management. So quality control management in the form of two places. So quality management in two doors. One is the entry door, another one is the exit door. So if the quality control management it is not very strong in the entry door, so then raw material, it will affect your raw material and production. On the exit, if your quality control is not sound, then whatever the damaged component is being sold to the customer, again it will come back. So it indicates the inherent weakness in the placement of the quality control in the either in the exit place or in the entry place. So these things are very important, and we have to check so whether there is adequate quality control is in place to see that the returns are at a very minimum level. Then to comment on the adequacy of the insurance cover for the stock, adequacy of coverage of all location storage, comment on the coverage of risk based on the nature of the goods, etc. That also to be commented. Then to comment on the system for movement of goods sent for processing, if any, and the adequacy of the control system. Then to comment on the movement of finished goods to various distribution center and the system adopted for controlling the finished goods lying in the distribution center, which are included in the stock statement. In case of part of the procurement of raw material from sister concerned associated company, then to comment on the reasonableness of the purchase consideration vis-a-vis the market related prices. Then the next part of our stock audit is evaluation of inventory. When I'm saying this valuation of inventory shall be done on the basis of cost or net realizable value, whichever is less. So just we have touched upon broadly the cost, how the cost is to be determined, what are the factors are to be included, what are the factors are not to be included. So all these things just we have understand. Then how the net realizable value to be determined. What is the meaning of net realizable value? Here, net realizable value, the cost of inventories may not be recovered if those inventories are damaged. If they have become wholly or partially obsolete, or if their selling price have declined, the cost of inventories may also not be recoverable if the estimated cost of completion or the estimated cost to be incurred to make the sale have increased. The practice of writing inventories down below the cost to net realizable value is consistent with the view that assets should not be carried in excess of the amounts expected to be realized from their sale or use. So we'll have to always look into it, what is the realizable value. So if the realizable value, at what point of time it is happening. So the realizable value, there are three stages. One is if you sell it as in the form of raw material. I procured raw material. Due to certain reasons, I am not able to produce. So I'm selling it back as a raw material. But if I am selling it back as a raw material, whether I will get back the money, whatever I spent, certainly not. It will be a distressed sale. If it is in a distressed sale, what will be the realizable value of the raw material? So that also to be looked into it. Similarly, if it is in the work in process stage, it is the semi-finished. Semi-finished stage as a very worst scenario. If it is in a semi-finished stage, so whatever expenses incurred till such time, then whatever expenses that are to be incurred in to make this component in the full form. So at this stage, if it is sold to an outside place, so what will be the realizable value? Now the third stage, now it is in the finished goods. When it is in the finished goods, what will be the realizable value? So all these things are to be looked into it to ascertain the correct realizable value to replace the cost whenever the realizable values are less than the cost. So when we take up a stock audit, the comments on insurance is very essential. So first thing is whether the stock hypothecated is adequately insured. So adequacy of insurance is the foremost important. The thing is the value of the inventory in the factory, correspondingly insurance, to what extent insurance is paid, is taken. So normally the bankers know they need not bother about all these things. They are happy so long as the insurance is taken to cover their limit exposure. But that is not correct, because insurance to be taken on the total value of the inventory. So assuming that the exposure, the borrower is enjoying the limit of 2 crores, whereas the stock available with the factory is at 20 crores. Insurance to be taken on the 20 crores, not on the 2 crores. But invariably, the bankers, they never apply their mind. For them, these are all the low priority, low key areas. So I would say this in all your stock audit reports, comment on insurance, definitely it will be there. So always first you take what is the value of the stock which is available on which the insurance is taken. So then there is a general principle on the insurance on the stock is insurance need to be taken 110 times, that is the 110% on the value of the stock lying in the company. So if the company's average stock holding is assuming that 20 crores, so insurance is to be taken on 22 crores, 20 crores plus 10%. 20 crores insurance to be taken, not on the 2 crores. That is not correct. So how you will ascertain the average value of the stock on which insurance to be taken? You will have to do the calculation of the last 3 months or last 6 months of the stock. You find out how much is the average. So whether the insurance is taken on the average of the stock. If it is not taken, then that also one of the point to be considered in our report. The next one is check whether the policy is in force. Unfortunately, many insurance are taken at the time of sanction of the facility. Subsequently, nobody bothers, neither the borrower bothers nor the banker bothers to renew the insurance. So whenever the policy is not in force, that also to be brought into our report. Then we check whether the stock with the third parties are also covered. So places of insurance is very, very vital. So they find adequate value is covered, then the policy is in force. What are the places? Initially, when the company they have started the banking with the particular bank, so they are doing this all this, they keep the stock in one places. But subsequently, they have opened the many branches, many outlets where the stocks are being kept in now other places. But other places are not brought into this insurance policy. In such a situation, though the value is covered, but when the place is not covered, so if any eventuality, any risk which are happening in the place where it is not covered, then they cannot claim the insurance from the insurance authorities. So places of coverage also is equally important while verifying the insurance. Next one is the check whether the bank clause is included in the policy. So invariably, each and every insurance policy which is taken to protect the interests of the bank should carry the bank name. But unfortunately, I would say this problem is 99%. It is happening in the bank industry. Wherever a bank takes over the exposure from the other bank, it is nothing but wherever the bank is grabbing business from the other bank. They think that, so they are very smart enough in grabbing the business from the other bank. In fact, literally many NPA accounts only it is being grabbed. So that's why the farmer bank, they are very happy silently. They happy of let the borrower go to some other bank. See, in fact, many circumstances when we do the statutory audit, they will tell, sir, don't classify this account as NPA. He is going to leave the bank. He will, because they get the exposure with the sanction letter from the other private bank like that. So that for that sake, they want to show the very colorful picture before the other bank who is very graciously, they want to take over the business. So this kind of scenario, the banker who took over the business, what happens, when they took over the business, they are very happy when they execute all the documents. They give least preference by amending the insurance policy. The insurance policy is taken in the name of the old bank, which is in active, which is having another 6 months period. Is in another 6 months periods to elapse. So the borrower, if you tell the borrower to take the insurance policy, he will not take. But the new bank, what they are supposed to do, They will have to insist the borrower, otherwise they will have to write the insurance company to change the bank clause. They never does it. Invariably, it will allow to continue. So unless otherwise we come and point out this issue, they never least bother about all this. So this is one of the gray area where we come across during the course of our audit. So please you ensure that adequate insurance bank clause is there in the insurance policy. Then the next point is check whether the stock is covered against all major perils is very, very important. Because see, the borrower know if the banker insists the borrower to take the policy, then the borrower what he will do for the namesake, he will take what insurance. So here the insurance on the granite slabs. Okay. So if you take this insurance on the fire insurance, on the burglar insurance, nothing could happen. So what they will do, but earthquake, all these things, nothing could happen. Only so they will take insurance on the earthquake. But if you take this another item, for example, the rice mandi. So rice mandi, where it is a subject to risk of the fire, subject to the risk of the theft, subject to the risk of the other damage due to the normal natural calamities. So, but here the insurance premium on this product is much higher than the insurance premium on the granite slabs, because the risk factor is much less. The insurance company, they will charge only lesser premium for this granite company, whereas they will charge more premium from the rice merchant. So this rice merchant, what he will do to satisfy the banker, further their auditors, he will take one insurance policy only against the earthquake. Earthquake, it never happens in neither in Andhra Pradesh or in Tamil Nadu. It is prone only in Gujarat, which has happened yesterday. You know, so they will safely they will take the insurance premium only to cover the earthquake. When you look at this insurance policy, yes, name of the borrower will be there, bank clause will be there, quantum of coverage will be there, item also will be there, but risk, the risk which are more risk, that is not covered. Then what is the use of taking insurance policy? So the risk factors which are part of the items which they are dealing, the relationship of the risk which we are anticipating on the particular item vis-a-vis the risk which are covered in the insurance policy is very, very, very essential, because there only the purpose, the object of the insurance is fulfilled. So what I'm emphasizing once again, you check whether the major risk factors are included in the insurance policy. Then check whether collateral security is also adequately insured. That also to be checked. Now, checklist for receivable audit. To verify the monthly booked statements submitted by the company during the reference period with the sales records and comment on the correctness of the data submitted. So here, friends, what happens now, whenever we do these receivable audits, we ask the breakup of the party, bill-wise breakup from the borrower. They used to give the bill-wise breakup. But if you adopt that bill-wise breakup, then that is not acceptable, that is not correct. Because we are being a stock auditor and receivable auditor. As I told you that our primary responsibility to do this assignment, financial responsibility. So financial records are to be thoroughly verified. I would say this, you can do the test check, you do the physical verification or not, that is a different issue. But financial records are 100%, you have to ensure what is the methodology, what is the internal control mechanism, what is the basis on which reports are being given. So whenever the receivable statements, age-wise book dates are given for the purpose of our exercise, so immediately, silently, you call for the GST returns. So when you ask the GST return, just to total the, let us assuming that the bank exposure on the DP on the receivable, it says only 90 days eligible credits. It means worst come worst situation, at the most, the eligible book date shall not more than 90 days of sales, isn't it? It cannot be more than 90 days, assuming that all the customers are not paying till 90 days, assuming that. So your eligible receivable shall not be more than the 90 day, more than the 3 months of GST returns. So this comparison between the GST returns vis-a-vis the eligible book dates is very much essential, because that is another documentary proof which is being submitted to the government. So then another information which are submitted to us. So if you compare these two, definitely you come across, you will be ending up very nasty situations wherein your GST return turnover for the 3 months is much lesser than the eligible book dates which they have given to the bank. Many cases it has happened. So this is very much always the reports or the documentary proof which they have produced to us for our verification. We'll try to match with the other informations which are given to the some other agencies, some other places. This kind of comparison always could establish to strengthening our conclusion. Comment on the age-wise breakup of debtors and their reliability. Comment on the system followed by the company to identify the account for bad debts. In case of drawing with by sister concern associate companies, then comment on the commercial nature of such transactions. Then comment generally on the spread of the receivables, to be specifically commented in case of concentration of sales to only 1-2 parties with focus on reliability of the debt. This is very, very important, because when a borrower who is doing the business, to how many customers they have in their hand, that's very important. A borrower, a company who is dealing with a very limited number of customers, though they give the quite substantial contracts, so they are unnecessary, they are taking the risk. Instead, another company who is dealing with the customers, more than 100 or 200 customers. So even 1 or 2 customers, if they are not continuing their orders, if the customers are, they close the business, the company will survive. On the other hand, a company who is solely depending on the other one big company, whereas that company is keep on placing the order. This company is having the highest risk. So what I'm suggesting you that, so the comment on the business proposition, customer proposition is also equally important to understand. So whether the customer profile is spread across the various customers in the industry, or it is focused only to the few handful of customers. Then other checklists in general, or general comment on accounting system and practices adopted. This is repeated again. To evaluate the position of sundry creditors for stock and comment on their level vis-a-vis the optimum accepted levels. General comment on utilization of bank funds and specific mention that we have discussed earlier. Amount due to from directors' firms and companies in which directors are interested. So other checklists are used capacity vis-a-vis the installed capacity, lifespan of machineries, then visible mark of bank hypothecation on walls and machineries. So whether bank hypothecation name is properly displaced. In fact, in one stock audit where we have conducted, it is a paper-based paper industry, paper board. They are manufacturing of paper board. So when we visited the factory, what happens? Even the company name itself not there. Then when we call for the balance sheet and the profit and loss account of the latest audited finance statements, we comes to know that the major revenue is the leasing, renting of the factories. So literally what happens, no? The company had they have letted out the factories to some other company. That company is carrying on the activities. So prima facie, if you look at the activities, everything is fine. But bottom the line, the company in which the bank is extending the finance, they are not doing the manufacturing activities. Instead, they have let out their activities to some other company. So is it permissible under the working capital exposure, whether it is facility sanctioned for that purpose, for letting it out? That is not permissible. But the bank management, they never bother about all these things. They never commented, they never mention in the report. So the facilities are keep on renewed year after year. But when we have pointed out this issue, then it will become a very big issue. Then subsequently they had to call back the facility of such nature. So while doing the physical inspection, we'll have to check whether the company, first of all, company name itself is there or not. Then next one is when the processing is taken place. So sometimes what happens, packing of the also takes place along with once the production is completed. So while they do the packing, the logo also it is being printed. So when the logo is printed on the finished product, whether the logo belongs to the company or some other company, these are the tips through which we could come to a conclusion whether the processing activity is being carried out by the company for the company or it is being used for some other company. Then income tax and other statutory liabilities for earlier years, if anything is pending, that also to be commented in our report. So drawing power statement. So this is one of the crucial in the stock audit, stock and inventory, stock and receivable audit. So drawing power, normally there is a format given by the bank. But in the month-on-month stock statements, has it been submitted as per the format given by the bank? It never happens. The borrower, according to his whims and fancies, he will prepare one draft, one format, and he will send it to the bank. Bank, I would say this is a very least low priority area as far as the banking industry is concerned. They collect this whatever reports given by the borrower and keep it on record. In fact, we came across the instances where stock statement of 1 month, ditto, copy and paste, the same stock statement of April, again the date is changed as May and it is submitted to the banker along with the covering letter. That is kept on record. Again May month, June. Like that, even without changing content, simply copy and paste. The banker also, they least bother what is inside. Simply they'll keep it on fire record. So this kind of approach is happening in the banking industry. Please you check the previous stock statement. Has it been submitted as per the format laid down to determine the drawing power? If not, then definitely it needs to be commented. Then another situations we come across, there are certain clever borrowers, particularly the borrowers who are having this guidance of the chartered accountant like us. See, so whenever we comment on the stock statement submitted, whenever we comment, there is a substantial variation between the stock as per the stock statement vis-a-vis the audited balance sheet. When we take up this issue with the branch people, what they will do is to, sir, only you people only you will be educating the borrower to do like this. So one hand you are misguiding the borrower, another hand you are coming and you are pointing out this is the irregularity. That is different. Now I am bearing a suit as a stock auditor. You give the explanation to a stock audit. That's it. If I am a statutory auditor, that is a different issue. This is a different issue. So who has done it, who has not done it, that is not a correct issue. Now I am a stock auditor, whether it is submitted as per the format. Second one is the date of submission. So date of submission in the sense that is the date at which the stock statement is disclosed. So many borrowers, they cleverly what they will do, instead of giving the end of the month, they used to give the stock statement either the 25th of that month or the subsequent month. So that is not correct, because there is a procedure, there is a mechanism. That mechanism wherein it says to submit the end of the stock statement within 7 days. If that being the situation, the borrower are required to submit the stock statement position at the end of the month, not on some other dates. If they have submitted the stock statement other than the end of the month, then that stock statement should squarely consider as not submitted or incomplete stock statement. So we'll have to take it that approach only, because see, interest is applied on which date? Well, interest is applied end of the month only, no? So there is a certain procedure. So similarly, stock position also is given at the end of the month. There is a significance, there is a logic, there is a methodology. So they should not change the methodology. So if you come across a stock statement which is given the status other than the end of the month, then it means that stock statement should not be considered. In fact, there is a deliberate attempt to give the false information. So the drawing power determination is one of the major role for a stock audit. Here, drawing power statement, by and large, it comprises of stock value. That is the gross value of the stock on which the date on which we are verifying the stock. Then less trade creditors. Then after deducting the trade creditors, we'll get the paid stock. From the paid stock, we apply the margin on stock. So there is a margin on stock. The percentage of the margin is determined in the sanction letter. So in the sanction letter, it will say stock will have a margin of 25%. Receivables will have a margin of this much. So whatever margin stipulated in the sanction letter, that margin to be applied accordingly, then the paid stock value is reduced. What is the significance of applying the margin on the stock? The reason is that the bank always expect, if I am contributing, lending 75%, at least bank borrower should contribute to 25%. At least 1/4 of the total value of the asset contributes by the borrower. So then only see, if the borrower contributes, if interest is in the business, then only he will show the interest to do the business, isn't it? That is the intention behind it, fixing the margin on the stock. Then after excluding the margin, then we arrive the figure that is the drawing power on stock. So that I am marking it as A. Then after that, now we are moving into the receivables. As far as the receivables, there are total realizable receivables all to be submitted. But what happens now? The receivables, lot of mistakes are happening in submitting the receivables. Many borrowers, they never submit the breakup of the receivables. They'll give the receivables, or either borrower, either customer wise there is a outstanding they used to give, otherwise receivables in total. In the total they used to give 90 days is this much, more than 90 days is this much, less than 90 days it is like that. So that is not to be accepted. So the borrower is expected to give the full list of the receivables outstanding on the date of the audit. So from that only we'll have to segregate whatever ineligible receivables. What is the meaning of ineligible receivables? So the bank in its sanction letter, it says the receivables up to this period alone, I can extend the finance. So depending upon the industry and the company customer profile, while appraising the working capital requirement, the bank will ascertain, okay, if the company is dealing with the blue chip companies, so they have the very they are prompt in really credit settling their sub dues, then we can extend up to 4 months. Whereas the company is dealing with the unknown customers, so we cannot take this. They will confine only to 60 days. The reasonable customer profile, they maintain up to 90 days. So it is depending upon the industry and the company customer profile, they fix the eligible book dates. So depending upon the eligible book dates, so we have to remove the ineligible book dates. If the sanction term says only 90 days book dates are permitted, more than 90 days book dates are to be excluded. So that is in the form of book dates not eligible for drawing power. So after excluding ineligible dates, the resulting is the eligible book dates. From that, so we'll have to determine the drawing power on book dates. So when you determine the drawing power on book dates, again there is a margin on the book dates. So the margin on the book dates, again there is a separate margin is envisaged in the sanction letter. It may be 25% or 30% or 50% or 50%, 40%, depending upon the customer profile, the sanction letter stipulates the margin. So after excluding the margin, you will get one figure. So that figure is the drawing power on book dates. That is the answer B. Now you add A and B. The aggregate total of the A and B is the drawing power of the borrower on the date. Now, the significance of the drawing power is that, so the borrower, whenever a cash credit facilities are extended to the borrower, the cash credit facilities are, by and large, it is available to the borrower for how many period? What is the period? It is a 12 months. And see the difference between the term loan and the cash credit facility is that cash credit facility is always having the period up to a period of 12 months. That is the reason it is called the short-term loan. The term loan, it is a long-term loan. So term loan which is having a longer period, so with the repayment. So over a period of time, the term loan balances are coming down. At one point of time, it becomes zero. Whereas in the case of cash credit, it starts with an X amount and end up with an X amount. But it is for a specific period of maximum period of 12 months. So there is a two level of checking. So the first level of checking is that the borrower is not expected to make use of the facility beyond the limit. So when the bank sanctions the facility of 2 crores, he cannot make use of the facility beyond the 2 crores. He always expected to operate within 2 crores. That is the one level of check. Second level of check is the drawing power. So drawing power is, even though the limit is 2 crore, whether adequate security is available in the form of stock and receivables, on which whether to what extent he is able to enjoy the facilities in the form of drawing power. So one is the limit, second one is the drawing power. So the drawing power always, it is lesser than the limit. So on the other hand, if there are certain circumstances where the drawing power is more than the limit, in such a situation, the borrower is expected to avail the facility only up to limit, not more than the drawing power. So now the situation is that a borrower is permitted to avail the facility either limit or drawing power, whichever is less. So whichever is less. Now we have a lot of challenges in determining. So though the table, it looks like very simple. Simply we replace the figure and arrange the drawing power. But is it really so simple? It is not really so simple. We come across a lot of challenges, particularly during the stock audit, because the stock audit where the quite substantial exposure of only are subject to the stock audit. We know very well a lot of professionals are involved. So they have given a lot of inputs to the borrower. As a result, they know how to give the incorrect or fabricated or status to the bank. So now as an auditor, we'll have to unearth such a, if something is not factual status by way of scrutinizing the stock statement. While scrutinizing stock statements, we come across a lot of challenges in determining the drawing power. What are all the challenges? The challenges in determining the drawing power is I think with your permission, I will take a cup of tea. Normally, whenever I take the session for our institute, no. So we used to have a 3 hours session, continuous 3 hours session. In between 3 hours, we will have a break of 5 to 10 minutes, so that the participants as well as the faculty could relax some time, so that we could refresh ourselves, so that we can continue our deliberation. I think we will have a little break, little bit 1 or 2 minutes break.
Yes,
Similarly,
no
the
problem.
participants also, they could take a break of
Yes.
1 to 2 minutes. Then we will continue after a break.
Yeah. You please, sir. Yeah, could you give them the hello?
Now I am ready. Shall we continue, sir? Chairman, Vice Chairman, sir. Hello.
Yes, sir. Sir.
Yeah. Now we can continue. I think all of you are ready. You know.
Yes, sir. Yes.
Okay. So there are certain important issues that have to be considered while determining the drawing power. The important issues are first, treatment of trade creditors. What is the meaning of treatment of trade creditors? See, I am raising an issue before you, whether the trade creditor are required to be deducted or not required to be deducted. Because I always very vibrant environment. Always I used to have a discussion in a vibrant environment whenever I take a sessions in a classroom. But today, being in a virtual mode nowadays, over a period of 1.5 years, I am speaking only with before the laptop, in my laptop. I do not know the audience, whether the audience are physically present or mentally they are following, whether they like my presentation. Otherwise, I let to change my tone and the presentation. I am totally on the dark. So whenever I raise certain interaction questions like this, there will be a more vibrant, more interaction. But it is a limited place where we cannot expect all these things. One hand I raise question, another hand I will reply. So the point is that treatment of trade creditors. Why the treatment of trade creditors? Whether the trade creditors are required to be deducted or not required to be deducted. What is expected? See whether the trade creditors are provided or not provided. This is also happening because invariably, if you go to the many stock statements are given without disclosing the trade creditors. That is totally incomplete. So incomplete stock statement as good as not submitted stock statement. So those stock statements are summarily it should be rejected and the borrower ought to be penalized for non-submission of stock statement by 2%. There is no second view on this. Now the situation is that where the borrower is provided the information of trade creditor, whether it is required to be deducted or not required to be deducted. That is a point of discussion. So here I am going to touch upon the working capital assessment. Working capital assessment is there are two types of assessment. One is the turnover basis of assessment. Second one is the tandem committee of assessment, otherwise the maximum permissible bank finance method, MPBF method. Okay, so the RBI circular on the determining the drawing power, they have issued in somewhere in 1991. That circular even now it is being followed by many banks. So as per that circular, it says any facility which is sanctioned based on the turnover basis of assessment, either 20% of turnover or 15% of turnover, whatever it is, in such a situation, trade creditors are need to be deducted. But what is the reason for deducting the trade creditors? So the trade creditors is nothing but it is a indirectly they are funding for a procurement of raw material. I am supplying goods to my company. So I am saying that don't I supply the goods to you. No problem. You give me the money after 30 days or 60 days. It means I am part of your financial for working capital gap. So when the supplier who is a contributor for working capital exposure, their stock also is lying. Why the bank funding is required? So to the extent of the trade creditor ought to be deducted so that we will arrive how much is the paid stock. From that, the bank is extending the finance. That is the logic and rationale. That is the reason the trade creditors are being deducted. But under the turnover basis of method, where the requirement of working capital is assessed simply in a crooked manner. I would say it's a crooked manner or in a simplified manner to help the small borrowers, because we cannot expect that small borrower to give the very lengthy projections with the maximum, the CMA data form, maximum permission, all these things, it is not expected from the borrower. Simply they'll go ask how much is the last year turnover, how much you will do it in the future, then you take 20% like that. So in such a situation, the assessment of working capital not done. Hence, that stock less pay unpaid, that is the trade creditors ought to be deducted. The balance on which the drawing power needs to be conducted and needs to be determined. The another scenario where the working capital facility is determined under maximum permissible bank finance method. When you say maximum permissible bank finance method, what is the methodology of arriving the working capital gap? So the working capital gap is nothing but current assets minus current liabilities. So current asset which comprises of not only the stock, not only the receivables, even the cash at bank, cash on hand, other advance to supplier, other components also there. Then if you take the current liabilities, it is not only confined to the trade creditors. So then other provisions, other expenses also there. So it is not right on the part of the bank to exclude the other component for determining the monthly drawing power. So RBI in that circular, they have mentioned that whenever a facility which is sanctioned under the maximum permissible bank finance method, trade creditors to the extent of the trade creditors mentioned in their projection while appraising the facility, you need not deduct in the monthly stock statement. So it means while giving them projection, so the projector in the projected balance sheet, the projected trade credit is shown as 20 lakhs. That party, when he submit the stock statement, in that stock statement of assuming that June 2021, in the June 2021 stock statement, that trade credit is shown 15 lakhs. It means that 15 lakhs is lesser than the 20 lakhs of projected trade creditors given. Hence, this 15 lakhs need not be deducted. Now, another month, July month, the borrower submitted a stock statement. The trade creditors is 25 lakhs. It means 25 lakhs is more than the 20 lakhs. That is incremental portion is 5 lakhs. So that month, the trade creditors to the extent of 5 lakhs alone to be deducted, not the entire 25 lakhs. So this is the understanding of the RBI in its circular issued in 1991. This circular, it is holds good even now. Many banks, particularly if you take the State Bank of India or Bank of India, other couple of banks, they are following the system. Whenever the maximum permissive bank finance methods are there, they exclude the trade creditors to the extent already mentioned in their projected balance sheet. So here, before you take this approach, you have to do it very cautiously. You will have to find out what is the bank policy on this. If you take, there are a couple of other banks, they are not following this policy. They deduct invariably total trade credit. So before you take a decision whether the trade creditors are to be deducted or not to be deducted, to what extent it is to be deducted, you'll have to find out what is the bank policy on treatment of the trade creditors. So accordingly, you take a decision and proceed for the determining the trade creditors. Then second one is the treatment of LC outstanding. So LC is nothing but a letter of credit arrangements wherein unknown by a supplier through issue of the letter of credits, the borrower gets raw material. The payment will be made after 60 days or 90 days as the case may be. So whatever stock procured and letter of credit arrangements, to that extent of letter of credit outstanding, that is also to be treated as a due to the supplier. So here the amount is not due to the supplier, instead the amount is due to the bank. But even though it is due to the bank, it is for procurement of stock. So to the extent of LC outstanding, which are attributable to purchase for procurement of materials, raw materials are to be deducted. Then the third point is items to be considered while arriving the monthly drawing cover. What are the items to be considered while arriving the drawing cover? That is very, very important. So when you say an inventory in the sense, what are the components are there? By and large, in our mind, it will come raw material, work in process, and finished goods. Fine. Only these three. What about other items? Consumables, stores and spares, packing materials, tools and dies. So whether all these things, whether it needs to be included as a part of inventory or not to be included, who is the deciding authority? Is there any standard format? Is there any standard understanding? Is there any institute guidelines? Nothing. Only the sanctioning authority to decide. If the sanctioning authority decides, okay, I will extend the working capital support for the consumable, fine. I'll extend the support for the packing material, fine. I'll extend the support for the purchase of the dies and tools, fine. Here you cannot say, no, this is as per institute guideline, it should be treated this way or this is that way. It is only the sanctioning authority who has to decide whether it is capital asset or the revenue asset. All these things will not come into picture at all. For determining for the purpose of determining the drawing power, it is for the sanctioning authority to decide what are the items or for which they are going to extend the finance. How will you come to know? You will come to know only through the sanction letter. In the sanction letter, they will mention the primary security. Under the primary security, what are the components are to be considered. See, in that, if they say that die and tools, that also you include it, because there may be a die or tool which is having the lifespan only for when you manufacture one product, that die will also cannot be reused. So one time, one strike, two strike, like that, limited life for dies and tools also is there. We do not know the intricacies and the bank policy on extending the working capital support. So we cannot take any decision on this. So we'll have to go by the sanctioning authority decisions. But invariably, nowadays, what happens? No, many sanction letters, there is no clarity. Simply, they will say single one line page. In fact, even pre-printed sanction letters also, it is come the many pre-printed. They'll say the facilities are as per the appropriate authority has sanctioned this facility with the sanction with the terms and conditions as mentioned in the annexure. That's it. The annexure they'll attach the that is higher up approval. So the clarity may not be there. Then if there is no clarity, simply shall we ignore? Again, we will not ignore such thing. Instead, we'll have to call for the appraisal note. So appraisal note also is very equally important to determine. So appraisal note plays a vital role in what are the items to be considered, how it should be considered. In that, if they have discussed on the other factors, then such things you include it. If they have not discussed on the other factors, or if they have declined the other factors by recording, so then don't include it. So these are all the very important areas to be looked into to determine the drawing power of a borrower. The next point is that impact of negative drawing power. This is very, very, very crucial, particularly stock auditor. Many stock auditor, they will struck in this aspect. So what is the meaning of negative drawing power, impact of negative drawing power on stock? Is it possible negative drawing power on stock? Is it possible? But in what circumstances it is possible? It is happening where my stock value, my paid stock is less, my gross value of stock is less than the trade creditors. My trade creditors balance is more, whereas my stock position is less. But this could happen invariably in the all balance sheets of the working borrower. If you go through the balance sheets of all the borrowers, I would say 90% of the borrower accounts who enjoys working facility, invariably stock, which is inventory, which is mentioned in the balance sheet on the asset side, which is lesser than the trade creditors, which is mentioned in the liability side. So this is one scenario. But during the course of our audit, but whenever the inputs are given by the borrower, probably he would have given the account and he would have given the inputs as it is without consulting. He would not have consulted the auditor, otherwise he would not have paid the fees to the auditor. So that's why he would not appraise. Simply they have taken the data and they would have shared with us. By doing this, all the calculations, we come to know that creditors are much higher than the stock. Then it is a negative drawing power on stock. If negative drawing power on stock, my contention is that this negative of the stock, DP on stock, whether he will net it off against the DP on the book dates. But in my previous slides, wherein I have mentioned A is DP on stock, B DP on book dates. And below I mentioned the total drawing power A plus B. It's a simple table. Whether this table invariably to be applied even in the case of negative drawing power on inventory. That is my contention. That is my point of discussion. Can it be netting it? Can it be netted off or not to be netted off? By netting off is right or not netting off is right. There may be a different version, because when I raised this same question before in my direct classes, the entire audience will be divided into two. 50% will say netting off should be done, then 50% will say netting off should not be done. Then I always be neutral. I always say it's depending upon this, because I will have to satisfy both group, isn't it? Then only I will be safely, I will come out of the audience room. No, I always be I am neutral so that I can satisfy both sides. So it is depending upon this situation. Now, what is the situation under which you take a decision, whether netting off or not netting off to be done? Now, there are various scenarios. The first scenario, why this negative drawing power on stock is happening? Why the trade creditors are much less higher than the stock? Possibilities are, see, my supplier credit period is much higher cycle, larger cycle than my production cycle, isn't it? That is, I have a credit period with my supplier for 60 days credit period, whereas I will be able to convert my inventory into the receivables within a week or within 30 days. It means my production cycle period is much lesser than my creditors period. If that being the situation, do I require working capital support on the procurement of stock? Not required. If it is not required, how the bank is extending the finance on the exposure on the stock? It is not correct. It means it is an appraisal blunder. The bank has done that. They does the blunder without applying their mind, without the need of the borrower, simply by looking at some other factors. Probably the color of the borrower who approached the manager, or the facilities, or some other underground, so many things. Let us not elaborate on this. But this is not correct. When this is not correct, when it is an appraisal issue, the facility was not appraised properly. You let plain blankly, you mention in your report, as per the operating aspects of the borrower, the borrower is ineligible to avail the working capital facility. However, it was not appraised properly. Hence, it is suggested to reappraise and reassess and extend the facility according to the genuine requirement of the borrower. So this needs to be categorically, we'll have to mention in our report. But the other scenario is that this is not only situation. Another scenario, okay, stock is there, stock values come down. The reduction in the value of stock, it means the inventory where it has gone, it has gone into the form of receivable, isn't it? The stock is finished goods. When it is sold, it is converted from inventory to the receivables. So if not in the stock, it is in the form of receivables. That is the reason I'm netting it off. If you say that is the reason for netting it off, but do you have certainty that inventory which has converted into the receivables, still it is in the receivables, or still it is fall under the eligible receivables? I will tell you the scenario where the receivables are, one borrower, he exported goods to one abroad. So it has reached belatedly, or the quality is inferior. So the export customer, they refuse to make payment. So the issue is the stock is pending at the customer place over a period of 1 year. It means the stock is converted into receivables. That receivables is already, it is the ineligible receivables. When it is already as an ineligible receivables, while determining the DP on receivables, you would have excluded as an ineligible. So when you excluded as an ineligible, is it right on your part? Once again, you deduct. That is not right. Now, third scenario is the stock is lost due to some natural calamity or fire or some other situation. So there is an insurance claim. Because of that, my stock value has come down. So when the stock value is coming down, as a prima facie, it looks like the DP is negative. But there is a reason behind it. There is a claim behind it. But the insurance claim amount which is pending with the insurance company, I have not accounted in my calculation sheet. Hence, so that is not correct. So my submission is that, so before you take a decision, whether the DP on the stock to be netting it off or not to be netting it off, it is not a standard decision. It is a unique decision to be taken depending upon the circumstances. So whatever decisions you make, you will have to categorically, you will have to mention in your report. But my submission, even though you come across whatever be the reason, the DP on stock is negative. So that, and the DP on receivables is positive. It is not a logic to renting it off, because the treatment or the stock is a separate asset, receivable is a separate asset. The treatment and assessment of the stock is separate. The treatment and assessment of receivable is separate. So the both assets is not unique in it is both assets are unique in nature. So they are not common assets. There are two different approaches, two different treatment, two different workings. So it is not right on our part simply netting it off the DP on the stock vis-a-vis the positive on the receivable, unless otherwise some specific reason behind it. So, but whatever it is, better you mention the reason, the justification, whatever the reason by which you take a particular decision, you make it on record so that later stage you will not be questioned for taking certain decision otherwise. Then treatment of sister consent dues reflected in the book dates. So treatment, say invariably, if you could go to the sanction letter, it says that the sister consent dues shall be excluded. But is it correct? Simply you exclude all sister consent dues. That is not correct, See, there are certain industry where there are multiple companies are there in the group. See, one sugar manufacturing company is there. Then another company is a paper manufacturing company. Both the companies are under the same group. So whenever a sugar is being produced, there is a byproduct is called molasses. This molasses is being used as a raw material for manufacturing the paper. So when both companies are under the same management, doesn't mean that there is no business relationship between these. There should not be any transaction between these two companies. Then what is the meaning of separate entity defined for each and every company? That is, we cannot simply take such a decision. So we'll have to go in depth. What is the rate at which it is being transacted? Is there any first? Both sister concerns, whether both are in the same related activities first. Then the transaction between these two companies are as an outcome of an commercial transactions. Whether they maintain the business transaction, they maintain the arm's length distance. If all the factors are satisfactorily explained, then nothing wrong in deducting the adding these sister concerns dues. Then treatment of advance to suppliers and from customers, again, it is a matter of subjectivity. So whenever you have sanction letter permits to extend the finance on the advance to supplier, then you include it, otherwise don't include it. Then audit report, which comprises nowadays, by and large, the audit reports, there is a pre-printed format. It is given to the auditors. Many banks, what they have introduced a system of online reporting. So there is a separate software package is there. In that software package, already all the pre-printed data are in the form of in the package. What is the name of the package? Software ethics software. By and large, many banks started using this ethics software for the purpose of reporting of concurrent audit, stock audit, credit audit, and various other audits. So the whatever formats they have given, we'll have to fill up that formats. But there is a last column, the other comments. So in that other comments, whatever major areas which you feel during the course of audit, that needs to be explained. I think by and large, I cover the major aspects in the stock and receivable audits. See, the stock and receivable, as I mentioned in my beginning note, it is such a very important assignments. More risks are involved because this is the report based on which there are fate of the borrowers has undergone changes. Many borrower accounts all along shown as a standard advances, it is treated as a substandard advances. Wherever the parties are so-called, it is treated as a very excellent party, then the investigations are initiated. So like that, this is only the area through which there is a lot of developments are being taken place. So since we are holding such a responsible assignment by way of a stock and receivable audit, our emphasis and the importance also very essential to take to give a quality report. But again and again, what I'm trying to convey through the stock audit, stock audit assignments are given to a chartered accountant by and large. In fact, even though the RBI and the Indian Bank Association permits to assign the cost auditors to do this audit, but nevertheless, the bank industry are again and again they're giving the audit only to the chartered account by and large, not to the cost audit. What is the reason behind it? Do you mean to that? Does it mean that they are so much of they have so much of respect on our profession? I don't think so. More than that, there are nobody in other profession, nobody is coming forward to take up this assignment for such a very low fees. But we are here, we never bother about the quantum of fee vis-a-vis the number of hours and the responsibility which we are shouldering. So the assignments are given to us. So, but if any problem arises, we cannot justify by comparing the fees and the time factor, all those things. We will be squarely responsible for non-compliance, not reporting. So my personal submission is that rightly or wrongly, having taken up with this audit, but once you take up this audit, don't try to compare, don't to upset yourself with the fees, compare with the fees and the time which you are going to spend on the audit. When you take up this audit, yes, audit is audit. So whatever exercise which are required, then you do it judiciously. Further, it is a one-time exercise, one-time assignment. With the relations to the borrower, I would say 99% there will not be any cooperation with the borrower. 99%. See, at least bank and all, we could somehow will try to pressurize the branch people to get the data. But very difficult to step into the borrowers because even the banker themselves, the borrower will not respect the bankers. That is the scenario everywhere. If that is the situation, how can you expect to go approach the borrower place and get all the information which are required and complete the audit? So if I would say, if you are justifying in completing the stock audit, if you complete with this disclaimer, I would say you are giving the quality of audit. I know very well out of my experience. So not even 100%, one account, 100% of information you will get it from the borrower. So invariably, you'll have to end up in the, at some point after you cannot pulling this audit. Out of my experience, I have come across many stock audits we have completed after 1 year. We have reported the stock audit after the physical verification, all documents, everything was done. So some lot of issues, deliberations going on between the borrower with the borrower and the bank. Finally, we conclude at some point of time. So by the time 1 year will go. So this kind of scenario we come across. So at the end of the day, please, you stick to your decisions. If you have any change in your decisions based on some documentary proof, ultimately at the end of the day, only the document will speak. So there is no proof for the number of items we have verified on the spot. Today he will tell, yes sir, this many items. When tomorrow when you work out, they'll say, sir, one item was that time he forgot to show it to him. If possible, let him come once again. Is it possible to go a multi number of times to verify? We'll have to close at some point of time. So like that, physical verification, more than the physical verification, the documentary proof and the internal control mechanisms are foremost important as a financial profession. I would say this stock audit, it is not to be emphasized, it is not to be given only to a chartered accountant. I would say this, the entire banking industry, they are playing game by throwing the responsibility on the chartered accountant fraternity. shouldering. They are shifting the responsibility on the hands of the chartered accountant. Their intention is not to get the quality audit. Had it been an intention, definitely they will not entrust only to the chartered accountant. They will engage the technical experts and they will mix the experts' opinion. Then finally we will correct and conclude. But it is not happening. When it is not happening, our conclusion also based on our financial and our professional restriction. Don't go stretch beyond that. So with these few notes, I'll conclude, because if you want to speak, I can speak any number of hours on the stock and receivable. In fact, stock and receivable audits, there is under multi-banking finance. There is situations where the consortium arrangement. So like that, lot of deliberation. Even the receivables audit with reference to the micro finance. There is a receivable audit for the NBFCs. Like that, it is a never-ending process. Anyway, so with the time which you are given 3 hours, I am justifying with whatever gained over a period of time I'm sharing with you. So with this note, I'll conclude today's sessions. Thank you very much.
Thank you, sir. Some questions are there.
Yeah. So what are questions? Probably they can raise it one after another. I'll try to give answer. Yeah.
Because this is only appreciating your this section, sir.
Thank you.
Section is very interesting. We all are interested in sections are like that. Comments are there. But members, please unmute yourself. Any questions are there that you can unmute and ask your doubts.
Yeah.
Members, please. Because this is very, very important, crucial. As sir has said, this is stock audit. Please ask any doubts, because this so I request the members to unmute yourself.
Yeah, sir, regarding the DP calculation, do we really, I mean, I'm talking like from the point of view of concrete auditor, do we really need to do the DP calculation, or do we have to check whether the bank has done the DP calculation correctly or not?
So this is, you are asking from the concurrent auditor point of view or stock auditor point of view?
Yes, sir, from the concrete point of view, not as stock auditor, but as a concrete auditor.
The difference between the concurrent auditor responsibility and the stock auditor is, stock auditor, okay, he is expected to go to the borrower's premises and find out the genuineness of the information provided. Okay, yeah, whereas a concurrent auditor responsibility, he need not go each and every month and find out. Okay, even he is required to inspect the unit. So once in a quarter, as per the scope of the audit. Okay, but even in the once in a quarter, he need not go and verify all the records. Simply he has to go and inspect whether the unit is running, whether that's it, he will come back, have a cup of coffee and he will come back, that's it. But he has to take a conclusion based on the information provided before him. So here the information provided before him is where the borrower is not providing the trade creditors provision continuously, then that also to be commented. So where the creditors are provided, it is underestimated, while comparing the audited balance sheet of the previous year with the stock statement submitted on that day. So that same trend he has to replace it here, and he has to do the recalculations. So the responsibility of the concurrent auditor is confined only with the information made available to him. Where the borrower is not submitting the stock statement month on month, he has to comment. Where the stock statements are submitted dates other than the end of the month, again that also to be commented. Where the stock statements are given with incomplete information. See, age-wise book dates are not given. Simply they are given one single line. Then he can comment like that. So the difference between stock audit, it's a specific assignments to go in depth and go to the borrower premises. Whereas concurrent auditor, he need not go into the premises, but the informations which are available before him, based on that, he has to take a conclusion. Okay.
Okay, so regarding the stock audit assignments, generally we do conduct the stock audit, meaning the book stock versus the physical stock, and we report the stock, and that stock as per the bank records are matching or not. To that action we do. Do we really need to do the DP calculation after doing the stock audit? Because in the SI engagement letter, we are expected to do the stock audit, meaning the physical verification of the stock and the location specified by the bank and the borrower.
But I would say the physical verification of inventory, is it required? Has it been, whether it needs to be done 100% or can we do the sample check? So the point is that with the time factor which is given to you, first one, with the fees which they have given to you, then the facilities which are available to you, definitely you cannot do 100% verification. If you are appointed as the stock auditor of a borrower who is dealing with scrapyard.
Yeah, that is
scrapyard. Very massive, it is the steel, scrap steels which is spread across in acres of land. So there are about 100 lorry loads everywhere it is spread. Is it possible for you to do this physical verification of each and every scrap which is kept in the yard? Totally not possible. Yeah. So there are certain circumstances where you cannot do 100% verification. Simply you will have to do some thumb rule verification. And you'll have to make a remark in your report. That's what I'm trying to tell you. Stock audit doesn't mean that 100% physical verification. It is totally not possible. There are certain places where you are asked to verify the jewelry shop. Easily you can count the number of jewels. So they maintain the daily end of the day stock position. Based on that, you can check how many jewels are there. Whether it is easily you can count and you can arrive. So one is the physical verification. Easily you can do it. Whereas this kind of yards, there is a coal field, lot of use, there are a lot of electricity, companies with the help of this coal, where the coal is being procured, it is spread across the place. Is it possible to do the evaluation? Then there is granite manufacturing company, where the big rocks which are being kept. So is it really possible to do this verification of all the items? It is not possible. So you will have to do these certain professional judgments and decisions is very much essential. You cannot do 100% verification, physical verification of stock. Similarly, valuation also, we are not that much competent. You take this granite slab, can you really do the valuation? Is it possible? Because one slab, one color is different from makes different from the other color. But as from our eyes, both are looks like the same. So there are certain special expertise is required for these various types of activities. I would say that though the bank is giving the assignment of stock audit, they are fooling our profession. In fact, they are very smart by throwing the responsibility on the chartered accountant fraternity. They are taking shelter under the chartered accountant fraternity. So any stock audit, we are not that much competent. We are not technical experts. Even not one technical expert cannot do this other type of stock audit. For each and every industry, there are special technical experts out there. We are only the financial professions. Our scope is confined only to the financial related activities. So whatever it is financial falls under the ambit of financial activities, you give comment. You do in-depth verification. Beyond that, you make a disclaimer and conclude your audit. I hope. So now I have clarified your doubt.
Yes, sir. Thank you very much, sir. Thank you, sir.
Okay, sir. Thank you very much, sir. Sir, members all have appreciated your efforts in this, and they have got the clarifications about the stock audit, sir. I hope so. So now I request our Secretary Prashant Kumar Panda, please propose vote of thanks.
Respected Vice Chairman CA Vasudeva Murthy Garu, Lane Speaker CA S.Dayanidhi Garu, senior members and other dignitaries, good evening to all. I am privileged to propose vote of thanks on behalf of for the session on my own behalf and behalf of the Visakhapatnam members. Sir, I convey my sincere thanks for accepting and being with us to share your experience and knowledge for our in spite of your busy schedule, sir. Sir, your deliberations on stock audit and receivable audit with support of institute guidelines are really wonderful, sir. Sir, your special focus on internal control evaluation, physical verifications of stock, checklist for before commencement, documents to be collected, taking experts' opinion, aspects like other aspects, certain aspects like control management, quality management, stock position and stock status, sales and sales returns, data saving analysis, adequacy of insurance and so on, or given insight and enlightenment on the stock audit and receivable audit, sir. Thank you very much for your experience deliberations. Members, request for attention for the next upcoming program, that is from 23rd onwards to 28th August. We are branch is conducting refreshing week-long webinar with 18 CPE hours, daily 3 hours. Request all the members to participate in these webinars and get benefited out of it. Thank you one and all. Thank you very much.
Thank
Thank
you,
you,
sir.
sir.
Thank you.
Thank you, Dayanidhi garu. Sir, once again, you have to come as in a physical mode next year.
Anyway, so only the God will decide. So it's depending upon your availability and my convenience. Will probably let us meet.
Yes, sir.
Anyway, thank you very much for
Thank you.
the opportunity given to interact with you. Thank you.
Thank you. Thank you very much.
Thank you, sir.
This camera se